Good day, welcome, and thank you for joining us for this video conversation. My name is Hennie Grové. I'm the National Sales Manager at Old Mutual Investment Group, or OMIG, Retail Division, and I have in the hot seat with me today Siboniso Nxumalo, who is our Chief Investment Officer. Sibo, welcome. I once heard good advice that said, if you want to have a good conversation, an easy conversation, avoid politics, religion, and Bitcoin. But now I thought, I don't want to have a good conversation. I want to have a great conversation. Yeah. So I definitely want to talk about politics at the very least. So given our context, I don't want to start off this quarterly video without touching on, I think, what's quite a hot topic in the South African landscape, and that is the recent election. I think if we roll back a couple of months ago, we were filled maybe with a combination of excitement, dread for the upcoming elections. Now we know what the election outcome was. There's been a government of national unity formed. So what I want to know from you is, in the investment team's eyes perspective, what is top of mind? What is top of your agenda, given what has happened in the political landscape?
So first of all, Hennie, I want to start with the process, because all our investment decisions are born out of a process that involves research. Before going into the election, one of the things we realized in the market was that there was a lot of anxiety about South Africa. South Africans have a tendency to be pessimistic, and that was priced in the market, especially in the domestic SA stocks. And so we did a lot of research. We looked at actually other countries where the dominant party had moved down to being the less dominant party. How have those transitions happened? There was an example of the CHP party in Turkey. There was one of the INC in India, Indian National Party. And we looked at those transitions in the history and what lessons we could learn from there, and how would we apply those lessons then in South Africa. So in terms of what's obviously happened then in South Africa post the election, we saw the markets breathe a sigh of relief. We saw South African companies completely outperform. We saw the rand strengthening. We saw our bond yields come down, and suddenly we saw optimism. And so therefore, from an election perspective, we've got to step back and say, hey, the South African elections were very good. Now, when we start comparing to what's happened in France, what's happening in the UK, what's happening in the US, we've really got to step back as a country and say, hey, our democracy has reached a state of maturity where we can have really great outcomes. And I think this was a particularly fantastic outcome for South Africa.
Maybe to make it a little bit more concrete, so that's the political landscape. I think many commentators have framed South African equities as a potential value trap. If you look at South African equities at the moment, are they a value trap? Are they a good investment? Are they fairly valued? What is your expectation?
We think South African equities actually are not a value trap. We think they're offering value. And we're going to compare them to three things. So if we look at the S&P 500, the biggest index in America, the most popular one, that one is trading on a forward PE multiple of about 21, almost 22 times. I think it's 21.9 times. Then South Africa is an emerging economy, so we've got to compare South Africa to emerging economies, which are Brazil, Russia, China, etc. And those, the emerging market index, the MSCI emerging market index, is trading just about 12.6 times forward PE. So America, S&P 500 is trading close to 22. Emerging markets are trading at around 12.6. South Africa, which is then the JSE, is trading at just under 10. Now, relative to our emerging market peers, we used to trade at a premium. And so in South Africa, we're trading at a discount. And even that discount actually has closed a little bit since the elections, because there was a relief rally of people saying, hey, these South African stocks are offering value, and we saw them running and outperforming. Now, what's even more pleasing with that was that actually our positioning in behalf of our clients, we didn't believe South Africa was a value trap. So we had more South Africans. So hence, if you look at our multi-asset funds and our equity funds are active, where we make active decisions, those funds were first and second quartile over the last quarter, especially over the last month, driven by the favorable outcome in the South African elections.
So if I understand you correctly, we have a lot of stuff to not be pessimistic about, at least from an investment perspective.
Yeah. We've got many strong businesses in South Africa, and I think people forget that. These businesses have been built over centuries. They've weathered a country that's gone through loads of transitions, run by really competent management. These companies know how to operate in stressful times. over and over again, each time South Africa has been counted out, it's come back. It's come back roaring.
I'm glad you mentioned the S&P 500. There's this expression that if the US sneezes, the rest of the world catches a cold. And I guess an extension of that the last couple of years has been if you have not invested in the US, you would have struggled. You would have had a challenging time. So if I gave you a time machine and I said you could go back a couple of years, which obviously backward looking, it's 2020 vision, so we have the benefit of that. But would you do anything differently?
So the US, I think I wrote an article about this on expectations investing, that the best time to invest in the US would have been in 2009. I think it was around March 2009. Remember what had happened? 2008 was a global financial crisis. So you had the financial crisis which originated in the US, which was a housing crisis, which then obviously spread contagiously throughout the rest of the world. And so who would have ever said, looking back, that buying when banks in America were going bust, then when housing sectors were going bust, when insurers were going bust, that was the best opportunity to buy in the US. But actually it was, and that's how markets work. Why? Because multiples were low. I think the same S&P 500 then was about 9 or 10 times. This is 2009, so it was very low. Whereas you're comparing it now, it's close to 22 times. At that time, earnings were low because the economy had just gone through a very deep recession. At this moment, the earnings are very high. And so therefore, you've also got to understand where your starting points are. And so where we sit, where we were today, yes, the best time to buy the US market was back then. But at this moment, we are nervous about the US market. I'll talk about why. The margins are very high. So the earnings are high and the multiples you're paying are high, but also it's a market that is concentrated around the Magnificent Seven, the Nvidias, Apples, Teslas, etc. These are the companies that have obviously driven the market. Now, the last time we saw the US market this concentrated was back in the 1970s in an era called the Nifty 50s, that if you had bought the companies then, these were the Kodaks and all of those companies which were thought strong, you could own them for 50 years. But the price you paid for them was so high that actually you struggled to make money out of them. And so at this point in time, it's worth asking the similar questions that, hey, this market has done well in America, but it's primarily been driven by a small group of companies which have done extraordinarily well. But for the multiples you're paying for those companies now, can that continue? And we would argue that those expectations are too high. So that's why in our funds, you would see that our weight in exposure towards the US actually aren't that high because we are cautious about the US. Now, that hasn't worked for us in terms of investment returns, but actually we believe that is exactly the very reason why it might turn around and work. And we saw a bit of that, I think, after these elections in South Africa, because we saw the rand strengthen a little bit, not a lot, but we saw the dollar weaken, and suddenly we thought, oh, okay, wow, there are returns here to be made from being away from the US.
I think that's always a difficult thing as an investor, is you tend to look backward, and when markets don't do well, you don't want to invest in them, which is potentially when they offer you really good prices. So you mentioned something right when we started around bond yields. You said they came back a little bit. I think bond yields have been elevated for quite a while and potentially offering great value. But there is also an expectation that potentially yields should remain relatively high. If you look at things like our national debt levels, things like that. Could you maybe give a little bit more context what you're seeing, maybe color a little bit more for us?
So bond yields are a reflection of the risk that is in an economy. And so whenever there's uncertainty and when there's risk, you see that in the currency, you see that in the bond yields of the country. So in South Africa, our bond yields were very high. So probably I think about in April this year, so 2 months ago, if we looked at our 10-year was trading around 11%, whereas now it's about 9.6. So you've had a 140 basis point improvement on the back of a better election. So the market has said, hey, maybe it's less risky. This is a good outcome. So we will show that in terms of the bond yields. But why should our bond yield? And obviously, we were overweight bonds. And so therefore, our multi-asset funds have benefited from that position. Now, in terms of where our bonds are, yes, now they remain quite high. Why? Because actually our fiscal situation is challenging. We are not growing as a country, and we do have very high levels of debt. And, it's easy to accumulate debt. And that debt, if you looked at our country, up until about 2008, 2009, again, South Africa had been paying back debt. But from that point onwards, we actually started accumulating debt. Now, it started slowly, and then obviously sped up through in the 20 teens. And so as that has gone up, then the risk in the country obviously then has increased. And because we aren't showing great GDP growth, then paying back that debt and that interest bill is starting to crowd out other expenditure. And so our bond yields then should actually remain elevated given the risks in the system. But when we compare them on a risk-adjusted basis relative to other assets that you can own, actually we still think it's worth holding on to them, because on a risk-adjusted basis, you can get paid back.
If I listen to you, one of the complicated things is making a call where to invest your money. And there's a lot of information to consider. I don't want to make that call, which fortunately one of the things OMEG has advocated for very long is proper diversification. I think if you look at popular publications like our long-term perspectives, we phrase it quite simply is don't put all your eggs in one basket. And I understand investing is a long-term game, but something I'd also like to understand is over the last quarter, could you maybe give us some guidance around some of the top performing funds? What drove that performance? And then let's call it some of the less top performing funds. What were some of the main detractors in those funds?
So let's start with our flagship fund, which is, let's say, the Balance Fund, the Old Mutual Balance Fund. So the Old Mutual Balance Fund showed strong performance versus, I suppose, especially the peer group over the last quarter. What drove that? The first one, let's start with the last topic we spoke about. We had a very significant overweight in South African bonds, and because of the favorable election outcomes, that then drove. But in the portfolio itself, we actually held quite a few SA Inc. shares. Now, versus the benchmark, we weren't too different from the benchmark, but versus peers, it appears then the peers were very negative South Africa, while we were actually fairly neutral. And so that was rewarded because we had a lot of South African banks and a lot of South African retailers, consumer retailers, and all of those actually started rising and rising. So that was additive to the thing. And then on the other side of it, on our offshore positioning was not as aggressive as some of our competitors in terms of the US exposure. And again, I think that worked well for us. So that's what drove the performance. Now, the funds then that did not perform as greatly, and in this particular instance, they're funds in our quantitative space. They actually held probably a different view in terms of there was more offshore exposure and there was more US exposure. And that then would have pulled those back. And so the difference here, it was about what was your position in South Africa, what was your position in bonds, and what was your position in currency. If you were pro-South Africa, you actually did well. If you were anti-South Africa, you did poorly.
I'm glad you brought in quants because as a house, we manage active, so fundamental, we manage quants, and we also do indexation. And I want to be slightly unfair because I have you in the hot seat here now, and all of the questions so far have been centralized around what value we're finding as active managers, as professionals in the market. But if you look at indexation or passive investing, as people normally refer to it globally, it's a growing trend, it's a growing theme, I guess, in the world. And if you look at some data, if we just take a global journey again, if you look in the US, over the past year, passive investing has overtaken active investing with well over, I think the number is over 13 trillion US dollars sitting in passive investing. And locally, it's much the same. We're a little bit behind and we're coming off a lower base. But if you look over the past decade, it's about a tenfold increase in the amount of assets allocated to indexation. So you broadly buy the market, it's low cost, you get that, you don't try and outperform it. What is your view? What has driven this growth in indexation, firstly? And then secondly, do you think we can compete as OMEG in that space?
That's a very good question. So in OMEG, how we view ourselves, we look at ourselves in terms of from product lines. We look at ourselves in 3 different segments. We've got indexation, we've got quants, and we've got fundamental or active decision making. Now, in all of those 3, we look at then which markets does each strategy actually perform. So I'll start with a fundamental strategy, then I'll come back and answer the indexation question in more detail. So fundamental strategies generally perform in much better or there's much richer alpha sources in narrower markets. Like South Africa is a small market. It's actually very narrow. It's driven by 3 or 4 really, really big things like resources. So it's the Rand hedges like the Naspers, and then there's SA Inc. So it's a more narrow market, it's a small market. Even in that space, we have like some funds in Africa. And again, small market, narrow market. And so therefore the opportunity where stock pickers can make a difference by doing investment research actually is very high. And that I think has been proven in South Africa. Then we've got our quant space. Our quant space is generally how we look at global investing. We've got a fund called Global Managed Alpha. And why do we use quants in our global space? Because quants requires large data sets and large broader markets. And actually that's when it'll work very well. And so therefore we deploy our quantitative strategies, especially globally, using quants because the world is bigger. You've got a massive universe of shares that then our quant analysts and researchers can work with and find things that work. And we have demonstrated that in terms of finding global alpha. Our indexation space also works well both in narrow and in broad markets. The advantage of indexation is obviously the fee that it gives you. And that fee is extremely low relative to the other 2 strategies that we have. And so for us as a house, our job is to obviously address the client need. What does the client need from us? Does the client need us to outperform the South African market? Then if they're willing to do that, then actually on an after fees basis, our analysts and our stock pickers should be able to deliver that in the fundamental space. Does the client want us to outperform the global markets? Then actually we've got a quant strategy that has proven to do that. And again, after fees, it should do that. But does the client want affordable or low-cost access to local markets or global markets? Then actually indexation is the best way to do that. And we will do all of those. Now, in terms of can we compete on an indexation basis? Of course we can compete. Why? Because we are large. I think we're the second largest institutional manager in terms of managing large pools of assets in the indexation space. So we've got great skills in that. We can track local and international indices. We've got lots of experience in that and a very credible team that has demonstrated their ability to do that and will continue. On the retail space, we're a little bit smaller than that, but we've got a lot more work to do in actually growing in that particular space and communicating with our clients in terms of our offerings. But we've got some really attractive offerings in terms of the core range in the retail space, which is our multi-asset range, which has done exceptionally well, again, in that particular space. And so indexation, it's fantastic strategy, and we've got it. And I think we have demonstrated our ability and our skills to execute it across the market. Its advantage is that we can give clients access to markets at a very low cost.
So is it fair to say as a client, as a financial advisor, as a planner, I can come to OMEG and I can pick across these different strategies? So I can use, for example, indexation, push down my costs a little bit. I can use quants in the global space, and I can bring in some active management where I believe there's particular skill or I want a particular source of alpha. Would that be a fair assumption or summary from what you said?
No, it would be a perfectly fair assumption. We basically have specific teams that are focused and incentivized on delivering specific outcomes. And those teams are built to obviously address the client need. And as a client, it's almost like going to a supermarket. There are different things that you can choose. But actually, what are your needs? And then we can provide that for you.
Okay. So I want to be slightly unfair again towards you, again, because I have you here in the hot seat. So if you look at all the strategies we have on offer, what would you pick? What would stand out to you as something that's particularly good in your mind?
Yeah. So I'll start in the local space, and then we'll go offshore. So for me, most clients actually have to go into our multi-asset strategies because those are diversified, local, offshore, fixed income, etc. So those strategies, so the Old Mutual Balance Fund or the core range, our core balance fund, those strategies are the strategies that one should build their core exposure. Those are important because, again, they cover a different variety of asset classes. So you get growth, but also you get diversification. When we go offshore, actually, then we've got an amazing fund. Again, the Global Managed Alpha, which is a global offshore equity fund. And it has generated alpha. It's been around for around 7 years and generated alpha for all of those 7 years. Now, this is the fund that has been able to invest in some of the Magnificent Seven stocks. So it has, in dollar terms, actually grown quite pleasingly and generated some phenomenal returns over the last 7 years since inception. And so that would be our flagship fund of choice if you want offshore exposure.
Perfect. Thank you very, very much. I feel like I've gotten a whirlwind tour of the world, of assets around the world, and essentially of what funds and products I can use to implement those different views. But more than that, thank you for being open, thank you for being candid, not just about where we're winning, but also where some of the challenges are in investing. As a client and as an investor myself, that is a level of transparency that I really like. And so with that, we would really like to encourage you, reach out to your financial advisor, reach out to your planner. If you are a planner or financial advisor, please reach out to your relationship manager, get in contact with them, and dig into the OMEG range of funds. There will be a solution for any problem that you're trying to solve for a client. Thank you very much. Thank you, Sibu.